Good morning, team. Thank you for attending today's financial performance review of Fraser and Neave Holding Berhad. Um, Next slide. Okay. Over its 140-year history, FNN has grown into a leading food and beverage company in Southeast Asia, with a diverse portfolio that includes iconic brands like 100 Plus. FNN has positioned itself as a strong player in the market. Today, we will analyze FNN financial performance for 2022 and 2023 and identify justifying on how we can improve the financial performance. Let us start with liquidity ratios first. Ms. Azura, could you please presenting regarding the ratios performance?
Sure, Mrs. Asha. For liquidity ratios, measure a company ability to meet the short-term obligations. For FNNs, we observe significant improvement in 2023 compared to 2022, where current ratio increased from Ringgit Malaysia 2 Ringgit and 68 sen to 2 Ringgit and 19.5 sen. It's indicating that FNN's claim of short-term creditors and increasingly well covered by its current asset. It's reflecting a stronger liquidity position and financial stability. Next, we move to quick ratio. For quick ratio, it is rose from Ringgit Malaysia 1 Ringgit and 59 sen to 2 Ringgit and 5 sen. It's showing FNN indicates a stronger short-term financial health for FNN, and it shows an improved ability to cover current liabilities without relying on inventory. Next, cash ratio. For the cash ratio, FNN jumped from Ringgit Malaysia 55 sen to 1 Ringgit and 21 sen. It's highlighting a substantial increase in available cash cover liabilities. This indicates a stronger liquidity position and financial health for the company. This result shows that FNN is well prepared to handle short-term financial challenges without needing additional financing and asset liquidation.
So, moving on to profitability ratios, FNN has demonstrated encouraging trends, underlining enhanced operational efficiency where gross profit margins rose from 26.27% to 28.69%, demonstrates FNN's improved ability to generate gross profit from its sales. This indicates enhanced efficiency in managing production costs and generating revenue, reflecting stronger operational performance. Net profit margin increased from 8.55% to 10.84%, showing enhanced ability to convert sales into profit. Next, moving on for the net profit margin, where the increase from 8.55% in 2022 to 10.84% in 2023 shows that FNN's improved ability to convert sales into net profit. This highlights better cost control and profitability, resulting in stronger financial performance for the company. Next, for the return on assets, improved from 9.12% to 10.6%, reflects FNN's enhanced ability to generate income from its assets. This indicates better utilization of resources, contributing to overall profitability and efficiency. Next, return on equity climbed from 12.81% to 16.17%, demonstrating that FNN's strengthened capacity to generate returns for its shareholders, where this reflects improved financial management and profitability, benefiting equity holders. These figures indicate that FNN's successful efforts in cost control and revenue optimization, enhancing its financial performance.
Thank you, Ms. Munira. I will proceed with efficiency ratios. Efficiency ratios presented meets a result where the inventory turnover improved from 3.66 times to 4.67 times. The improvement in inventory turnover from 2022 to 2023 suggests that FNN managed its inventory more effectively, translating to better sales efficiency. A higher turnover ratio indicates a strong demand for products and efficient inventory control, reducing the risk of excess or obsolete inventory. However, fixed asset turnover in 2023 highlights a reduction in the efficiency of using fixed asset to drive sales, which is from 2 ringgit and 28 cent to 1 ringgit 92 cent. This could be attributed to increased fixed asset investment in 2023, which may not yet have fully translated into higher revenues, or it may reflect operational challenges. Average collection period decreased from 70.74 days to 52.06 days, showing faster debt collection and improved cash flow. This change likely contributed to improved liquidity and working capital management. It also highlights enhanced customer credit policies or stronger efforts in accounts receivable management, allowing the company to access the cash faster to reinvest in operations. Next is total asset turnover. Also saw slight declines from 2 ringgit 28 cents to 1 ringgit 92 cents sales, indicating lower efficiency in generating revenue from assets. This could stem from increased investments in assets without a proportional increase in sales or operational challenges affecting the productivity of assets. While the drop may raise concerns about short-term efficiency, it might also reflect strategic investments for future growth. While the receivable turnover ratio remains unchanged, the improvement in the average collection period indicates the FNN managed to maintain consistent collection frequency while shortening the time taken to collect receivables. This reflects effective management of customer credit policies and accounts receivable processes, contributing to stable cash flow. While overall efficiency has improved, the slight decline in asset turnover ratios signals a need for careful monitoring. Thank you.
Thank you, Ms. Aris. Now let's examine leverage ratio, which assess FNN reliance on debt. For the debt ratio for 2022, FNN Holding Berhad had a debt ratio of 29%, which means that 29% of the company's assets were financed by debt, while the remaining 71% were financed by equity or retained earning. In 2023, the debt ratio increased to 34%, indicating that the company's assets were financed by debt, while the remaining 66% were financed by equity or retained earning. The increase in the debt ratio from 29% in 2022 to 34% in 2023 indicates a higher proportion of total assets financed by debt for FNN. Next slide. Next, on the debt to equity ratio, which rose from 40 cent in 2022 to 53 cent in 2023, reflects a growing leverage for FNN, indicating that for every 1 ringgit of equity, the company has 53 cents in debt, which may suggest increased financial risk, but also potential for higher returns on equity. Next. Regarding the times interest earn ratio, which dropped approximately 18 times in 2023 compared to 78 times in 2022, demonstrates a significant deterioration in FNN's ability to meet its interest obligation, indicating a weaker capacity to cover interest expenses with its operating income. While this suggests a higher financial risk, it may be part of a strategic plan to finance growth. However, the declining times interest earn ratio warrants attention to ensure debt level remain manageable. Next.
Thank you, Tim, for your detailed presentation on FNN financial performance. Before we move into a discussion, so let me briefly explain the trend in earning per share. So in 2021, the basic earning per share was 107.8 cent, showing steady performance. Despite challenges from the global pandemic, FNN managed to maintain profitability, and this was likely due to the strong cost management and stable revenue. In 2022, the EPS dropped slightly to 104.5 cent, a small dip compared to the previous year. This decline could have been caused by challenges like higher costs due to inflation, supply chain issues, or market competition. Even with the decrease, the company still delivered a relatively high EPS. In 2023, the EPS jumped to 146.5 cent, a big increase compared to the previous years. This strong growth suggests that FNN had a very profitable year. The rise was likely driven by high revenues, better cost management, and strategic decisions. Over the 3 years, the EPS showed a fluctuating trend with a slight decline in 2022, followed by a strong rebound in 2023. This upward trend highlights FNN's ability to recover from challenges and achieve significant growth. So now, let's open the floor to a discussion on how FNN can further enhance its financial standing. I would like each of you to share your thoughts based on the trends and insights we have reviewed just now. Ms. Azra, let's start with you.
Thank you, Mrs. Aisha. Based on the liquidity and efficiency ratios, FNN has shown a significant improvement, but I believe there is a room for optimization, particularly in asset utilization. The decline in fixed asset turnover and the total asset turnover, it indicates inefficiencies in leveraging our investment to drive revenue. To address this, FNN could streamline its operations, reduce waste, and enhance workflow processes. For example, we adopting automation for repetitive tasks can significantly improve productivity and lower operational costs.
Good point, Ms. Azra. Automation could indeed play an important role. So, Ms. Munira, do you have any other suggestions?
I agree with Ms. Azura on the need for optimization. However, I am also concerned that about the company's increasing reliance on debt, as reflected in the rise of debt ratio from 29% to 34%, and the debt to equity ratio from 40% to 53%. This trend poses a financial risk, especially during economic uncertainties. To address this, FNN could balance its debt levels by reinvesting profits and exploring equity financing options, such as issuing new shares or forming strategic partnerships. Refinancing to secure lower interest rates could also help reduce financial pressure.
Okay, that's an excellent observation, Ms. Munira. Managing debt effectively is crucial for maintaining financial stability. So, Ms. Arismia, what are your thoughts on this?
I would like to highlight the sharp decline in the times in interest earn ratio from 78 times in 2022 to 18 times in 2023. This indicates rising interest expenses, which could strain profitability. To mitigate this, FNN should explore cost-saving initiatives such as improving operational efficiency and controlling expenses. Additionally, refinancing debt to secure lower interest rates or extending repayment periods can improve cash flow. Alternative fund resources like selling non-core assets could also help reduce reliance on debt.
Yeah, thank you, Ms. Alisni. These are practical steps to manage financial risk. So, Mr. Ahmad, do you have anything to add?
Yes, other than that, I like to focus on the average collection period, which improved from 70.74 days to 52.06 days in 2023. While this is a positive trend, there is still potential to do better. Refining account receivable processes and adjusting customer credit policies can further enhance cash flow and working capital. Strategies like offering early payment discount, tightening credit terms for high-risk customers, and using advanced analytics to monitor receivable can provide better result. Strengthening cash flow will also support investment in growth opportunities. That's all from me.
Great insight, Mr. Akmal. Strengthening cash flow is essential for operational flexibility. So finally, I would like to address long-term growth strategies. Expanding market presence, particularly in high-growth regions, is a key area FNN should prioritize. Strategic partnership, joint venture, and investment in these regions can drive revenue growth. Additionally, product innovation is crucial. Developing healthier options like low sugar beverage or organic ingredients and focusing on eco-friendly products and packaging can align with evolving consumer preference.
I completely agree, Mrs. Asha. Expanding into high growth regions and innovation to meet consumer demands will enhance FNN's market position.
Absolutely. Aligning with consumer trends, especially health conscious and environmentally conscious preferences, will not only drive sales but also build brand loyalty.
And by managing resources more effectively, FNN can achieve these goals while maintaining financial stability.
So it is actually about balancing growth strategies with financial discipline. If FNN can implement this measure, it will strengthen its position as an industry leader.
Thank you, everyone. This has been a productive discussion. Your insights will be invaluable as we look to enhance FNN's financial performance. So let's continue to monitor these strategies and refine them over time. That's all for today. Thank you, and I'll see you all at the next meeting.